Well, hello everybody and welcome to our weekly webinar. My name is Ben Smith with RealWealth. So glad you could join us. Today is April 29th, 2021. And as you can see on your screen, we're going to talk 1031s today, which is kind of appropriate considering all the news, but you know, it's appropriate anytime to talk about 1031s. And we're happy to have Dino with us. Hi, Dino.
Hi, Ben.
Welcome once again to our weekly webinar. So go ahead, if you could Freudian slip, if you could advance for me by one slide. Strategies mentioned in the presentation may not be appropriate for everybody. Other options not mentioned may be more suitable for your specific circumstance. Consult your personal accountant, tax advisor, and/or attorneys to discuss your situation. As always, past performance is no guarantee of future results. Real estate purchases are subject to investment risks, including the possible loss of amounts invested. While every effort is made to maintain accurate and current information, the possibility of errors and/or updates always exists. You know, that disclaimer mainly applies to, you know, when we bring property teams out. Today's a little bit different, but it's still, you know, it's an overall truism that you gotta be careful, do your due diligence, and watch what you're doing. All right, advance for me, please, and I will talk about you, Dino. So we've had Dino, you've been on a couple different times. You know, we have you listed as one of our qualified intermediaries that we highly recommend on the website. If you log into RealWealth, go over to the left side of the screen. It's 1031 qualified intermediaries, and there you are listed. You've done over 10,000, a lot more 1031 exchanges. These numbers, we put the plus in there, but it's actually gone up a little bit beyond that. And you've taught over 2,000 seminars on 1031s, which is pretty impressive. A lot of those in live environments, you know, with adoring fans screaming and stuff. Yeah.
The fun ones.
The fun ones. Okay. All right, and you are with Asset Preservation Incorporated, and you are the VP and Division Manager. So again, we're happy to have you, and you always keep things interesting, and I doubt today will be an exception. So go ahead and advance, and I'm gonna kick it off with one particular little story. This happened like really recently, like within the last couple weeks. One of my fellow investment counselors has a client that was doing a 1.4 million exchange, and she turned one property, I think in California, with a cash flow of $800. I mean, they were managing it themselves, and so there's one less cost, and they were making $800 a month. And they basically turned that into 8 homes, and they're anticipating over $6,400, that's $6,400 a month. And they're not even managing it themselves anymore because these properties aren't where they live. These properties are, you know, a ways away in a couple different markets, 3 different markets, I think. And so there's the slide with the illustration. 1.4 million rental property, everything I just said, and it's turning into 8 properties with all that going on. And so, I mean, this is a realistic example, not some pie in the sky, if only type thing. I mean, this literally just happened. And you know, these are comments directly from her. 8 times the cash flow with property managers, not us. And I know we can grow this if we want. We actually bought fewer homes in diverse markets that we felt comfortable traveling to. That was just her particular criteria, just to get through the exchange. And a couple of their little comments, you know, she has a few tips for people. You know, she didn't haggle on the price if it was in the ballpark or nitpick on details, knowing that that the market is growing, and she just refused to allow the experience to stress her out and just kind of trusted, but yet still did a fair amount of due diligence. And you know, to go from one property where all your assets are all tied up in this one market that happens to probably be at the peak, could come down at any moment, into 8 properties in 2 or 3 different markets. Actually, she was in Charlotte, Jacksonville, and Tampa. So 3 different markets, well diversified, 8 different properties. If a tenant disappears, you've only got 1/8 of the rent not coming in, not 100% of it. So anyway, that's just a shining example, and we see examples like that all the time. And I thought this was a really good one to bring up, and it was, you know, brought to my attention, and I'm just thrilled to bring it on. But she's very, very happy about that. All right, if you could advance one more slide for me. And I'm going to turn it over to you, Dino, and you just do your magic, and we're going to take Q&A at the end. And the one request I have is that, and somebody's asking, is this being recorded? Yes, it is being recorded. So if you do have to go early, we will have it up on our website soon, probably within 24, 48 hours. And my request is, if you're asking questions, try to keep it general. If you go into all kinds of granular detail about your specific situation, I'm not going to read the question because it's not really applicable to everybody. But without further ado, Dino, take it away.
Okay. Well, welcome everyone. Happy April 29th. It's hard to imagine that we've gone almost 4 months in this particular year. And I want to say thank you to RealWealth for inviting me to speak on 1031s. What we're going to go over today, and this is an overview of 1031s. We're going to talk about market conditions and such, but I'm going to cover the current tax rates. So most of you probably are familiar with it, but I'm just going to give you a reminder. I'm going to take you through the guidelines of a 1031. We're going to talk about the aspects that you need to meet those guidelines to comply with the 1031 code itself. So we're going to talk about the delayed exchange, identification rules, things you need to remember, and advanced planning. And as Ben said, any Q&A, type it in. Keep it short, simple, general. It makes it very easy for a presentation like this. Okay, so let's talk about what the current tax rates are for the federal. First of all, when you have investment real estate, one of the advantages of owning investment real estate is you're depreciating the property, which lowers your real estate taxable income while you're operating the property. So in other words, if you're getting $30,000 in rent, your depreciation is $5,000. You're only reporting like $25,000. That's one of the beautiful things about depreciation. Now, I know I didn't bring in all the other expenses to ownership, but I'm just giving you what depreciation does. So it's a non-cash expense that lowers the real estate taxable income. But when you go to sell the property, it has a tax rate. So that's taxed differently than the capital gain rate. So depreciation has a tax rate of 25%. Okay, so you have to know that that's going to be a tax coming right off the top from the sale of an investment property. The next tax rate that you're going to be faced with is going to be the federal capital gain rate. Now, right now, there are two rates. There's 15% and there's 20%. 15% kicks in when you are, basically if your income is below $445,850, if you're a married couple, below $501,600. If it's above those numbers, now you're going to be taxed at the 20% tax rate. Now, I'm going to pause here for a second, and just because if anybody was paying attention last night, President Biden had rolled out his plan, and part of his plan was talking about the potential of increasing capital gain rates. Now, I just want you to realize and focus on the word plan. All right, this is a proposal. Nothing is set in stone at this point in time. Another issue that's brought up with his proposal is going to be 1031s and how 1031s are potentially going to be impacted by this. So again, merely a plan. Right now, as an industry, we have been monitoring this. We have been monitoring this actually since he was candidate Biden, working on making sure that 1031s stays in place, and if there's any tax law changes, that our code is being protected, because it's a code that actually generates a lot of activity financially. And so and this year actually we've hit our 100 years of being a part of 1031s. Now, I've seen a lot of articles this morning, especially like the Wall Street Journal, and they continue to refer to 1031s as a loophole. I guess being in the 1031 industry for 19 years, I kind of take offense thinking I'm a loophole, because we're actually a part of the code. Okay, so hopefully, we're going to be able to maintain 1031s with this new proposal. We'll see what's going to happen. I would just say, as consumers, as investors, just keep your eye out as to what's going on in Washington. Okay, again, these are plans. These are not in concrete yet. We'll just see how everything unfolds. Okay, the third tax that an investor is going to be faced with is called the net investment income tax. That's a tax if your income is more than $200,000 as a single taxpayer, $250,000 as a married couple. That's an additional tax that you're going to be faced with. So you can see at the federal level, you've got depreciation recapture tax at 25%. You have federal long-term capital gain rates, which is 15 to 20% currently. And then you potentially have on top of that another 3.8% that you could be subject to. And let's not forget about the states, because people forget about when they're calculating how much am I going to have to pay in taxes, they're going, what's my federal taxes, but they forget about the state. If you're in a state like mine, which is California, you can be subject to as high as 13.3%. So the tax rates at the state level, you have to look at that as well. So when you're doing a 1031, you have the opportunity to defer the tax on these taxes, both state and federal. Now, I will say that there is one state that does not comply with the 1031, and that happens to be Pennsylvania. But if you're not sure about whether a state complies or not, always make sure your tax advisor looks it up, okay, just to make sure. Majority of the states do, Pennsylvania does not, but there may be some nuances in other states that you may want to check out. Okay, now let's talk about the fact that you get to defer the tax. There's certain rules that you have to comply with. As I said, it's a part of the tax code. So when you hear people talk about a 1031, you might hear the term safe harbor. Well, a safe harbor basically means if you follow these guidelines, then you're going to be safe in your transaction. So one of the basic requirements, there are going to be 4 of them that are the basic requirements for a 1031. One of the major ones is the property qualification. So in other words, what type of property is it that you're selling? First of all, it has to be real property that's either held for trade or business or for investment. So it's real estate. So if it's on leased land or something, you have to be careful of the terms of the lease, because some leased land, the lease may not be long enough for the property to be considered real property in an exchange transaction.
Hey, Dino, I'm going to ask you a question real quick. I had a question come in. It's completely, I'm not going to usually interrupt you, but on state taxes, and I thought this is a good one. Do you get taxed on the state rate where you live or where the property is?
Could potentially be both. Okay, so for example, if you're buying, because you have the state tax, okay, where the property is located, and then you have where you're living. So if for example, in California, I live in California, but my properties that I have are in Florida. Florida does not have a state income tax. So I would think, okay, as an investor, I don't have to pay the state tax, right? Because my property is in Florida, but I'm a California resident, so I have to pay California taxes. So when there's a state tax and you live in a different state, there's probably going to be blends where there's going to be credits from one to the other. Okay. Right. So just because you're in a non-income tax state where your property, don't think that if you're in a state that collects tax, that you're not going to have to pay that state tax where you're residing.
Right. Okay.
Okay.
Thank you.
Okay. All right. So to go back to the property qualification, so it has to be real property that's held for trade or business or for investment. Sometimes people will say, well, I'm selling my primary residence, and the gain on the sale of the primary residence is more than the exclusions of 250 or 500,000. So they think they can do an exchange. You cannot. A primary residence is a completely different tax code. So the property has to be investment real estate. So you cannot be living in it at the time you sell it. And I'm referring to mainly a single family rental. Okay. So that's one of the requirements. Must be real property held for trade or business or for investment. Keep in mind that that property has to be held for trade or business or for investment on the other side of the transaction as well. So it's not just the sale side. It also has to be on the purchase side that the property is going to be held for trade or business or for investment. Sometimes people say, well, can I move into my new property that I acquired as a part of an exchange? It's got to be held for trade or business or for investment. Subsequently, can you change the use? Yes. Always talk to your tax advisor about when that would happen. All right. So that's one of the things, basics is that the real property. We talk about like-kind property, and let me just focus a little bit on that too, because sometimes people are think like-kind means like-kind. So single-family home or an apartment building, I have to buy an apartment building or a shopping center. No, it's investment real estate for investment real estate. So the fact that I might go from a single tenant triple net drive-through Taco Bell to 15 single-family homes, I still qualify for the like-kind component because I sold an investment property and I'm buying an investment property. All right, so hopefully that makes it a little bit clear that like-kind is not so specific. I had one person say, well, I'm selling a property that has 2 bedrooms and 1 bath. Do I have to buy another property that has 2 bedrooms and 1 bath? No. Okay, investment for investment. Okay, now the next basic requirement is going to be how much money do you have to spend? So what do you have to do to meet the deferral requirements? Well, you have to purchase property or properties equal to or greater than your sale price net the closing cost. You have to spend all of the cash and you need to replace any existing debt. So I can do this as an investor by buying one property, or I can accomplish this by buying multiple properties. Now, Ben, I don't know if that example you started off with was an exchange, and if, you know, so I'm going to make this assumption it was in that case. I mean, because if you're selling out of California, you probably are doing an exchange because you probably have a lot of gain. But you can see in that transaction, the person went from one property to buying 8 properties. Okay, so you can buy multiple properties in the exchange as long as the aggregate meets your minimum requirement of buying equal to or greater than. More is always good in an exchange. Sometimes people think, well, I can't buy more than I sold for it. No, you can. You can buy higher than what you want. And in operating the property, you probably want to. Okay, and we're going to talk a little bit about leverage later. Now, one thing I do want to focus on when you talk about replacing debt, because a lot of times people get confused about thinking that the only way I can replace the debt is by getting a new loan. And that's not 100% accurate. Okay, when we talk about replacing debt, we're just basically saying you have to bring in either money from outside of the exchange to cover the loan that was paid off, or you can go out and get a new loan. There are some instances when I'm working with investors that their loan may be only $50,000. And in their case, maybe they don't want to take on any new debt. They can bring in $50,000 to cover the debt that was paid off when they sold the property. So just think of the word replace debt, not necessarily that you must get a new loan. You just have to replace the debt. How you replace it is either by getting a loan or bringing in cash from outside of the exchange to make it work. Okay, so that's one of the requirements. Now, I'm going to touch a little bit later about when I talk about the net sale price, because there's certain closing costs that are associated with the exchange and there's some that are not. But I'm going to circle back to that in a little bit. Ooh, did I just use those words, circle back? I hate those words. All right, the third requirement is the timeline for the exchange. So regrettably, we don't have forever in order to complete the exchange. The government has allocated a certain amount of time to finish your exchange and when you have to identify. So you have to complete your exchange 180 calendar days from the date of your closing of the sale. The first 45 days of that 180-day period is when you have to identify the property or properties that you would like to purchase as a part of the exchange. I'm using the words calendar days. They're not business days. So if the 45th day or the 180th day falls on either a Saturday or Sunday or a holiday, you still need to finish your exchange by the 180th day, and you need to identify by that 45th day, whether it falls on a weekend or a holiday or not. Now, the hard part to the exchange right now is going to be the 45 days in identifying the property. Okay, so just keep that in the back of your mind when we get to the identifying parts of all of this. All right, so just 45, 180 calendar days. I still get the question, are there any extensions due to the pandemic? And the answer to that is no, those extensions have long expired. There was back in 2020 an extension for due to the pandemic, but that ended on July 15th, 2020. So there are no extensions due to the pandemic. So just know that these are right now. These are the timeframes for the exchange. The fourth requirement in doing the exchange is you have to identify. So there's certain rules that you're going to look at in identifying, and identifying is very, very specific. So when somebody is doing an exchange, they have to identify the property or properties that they wish to acquire as a part of an exchange. I like to say that there's the technical and then there's the practical. The technical means there is going to be an identification form that we as a qualified intermediary are going to provide you with. So you're going to have a piece of paper and you're going to need to fill in the address, the city, and the state of each of the properties that you are looking to acquire as a part of the exchange. It has to be signed by the taxpayers, dated, and returned by midnight of the 45th day. Very important to understand that what the properties that you list on the formal ID cannot be altered after the 45th day. So you need to be very, very clear as to which property or properties you're going to be acquiring as a part of the exchange. You're going to be filling out, dealing with contracts. You're going to be making offers up and back. The ID form generally does not come in until you're closer to the 45th day. Just from a transactional standpoint, when you're out there making offers on properties, now we'll talk about new construction later, but when you're out there making offers on properties, okay, you may not have, your offer may not be accepted. So you're not going to put that property on the ID form, okay? So that's why you wait till you get closer to the 45th day. Now the practical side of the ID is that you are in contract with the property or properties that you wish to acquire in an exchange. And that not only that you're in contract, but you're already well along your way with doing all your due diligence and your inspections, because you want to eliminate the properties that you're not going to be buying as early on as possible when you're dealing in an exchange transaction. Okay, very important to understand how all that plays out into an exchange. And it's also important to make sure that if you intend to get financing, that you're in really good communication with your lender to make sure that all these aspects of it are going to be met as well. Because sometimes that the appraisals may be coming in a little bit later, your ID is coming up. These are all real situations in a 1031. All right, so make sure that you're working closely with your team and staying diligent during the first 45 days for sure of your transaction. All right, now let's go back a little bit and talk about closing costs, because when you're doing an exchange, there are going to be some closing costs that are going to be associated with the transaction. The most common one is obviously going to be the real estate commission. So when you're putting your property up for sale, there's going to be a realtor that you're going to be paying in most cases. All right. Some people sell the properties by themselves without using a real estate professional, but majority of the times there's going to be a real estate agent. So your commissions. So a real estate commission is considered an acceptable exchange expense. So is the title insurance premiums. Closing costs, attorney closing fees and or escrow fees, depending on which state you're operating or selling out of. Any legal fees associated with the transaction, transfer fees, notary fees, recording fees, and the qualified intermediary fees. So those are considered typical exchange expenses because that's the cost of transferring the property. Okay, so that's the key. It's cost of transferring the property. Now, there are some expenses that may come up in a transaction that are not necessarily considered acceptable expenses. If you're selling, for an example, an apartment building or a retail shopping center, you're going to have prorated rents and security deposits. Okay, in those instances, if you're selling to a buyer and you tell the buyer, I'm going to credit you the prorated rents and security deposits, then what you're going to find out is that's going to be taxable because that's money not coming into the exchange. When you think about prorated rents and security deposits, think of it as operating expenses, not an expense of transferring the property. So there are ways of dealing with these issues in an exchange, and the best way would be to bring the money in. So that way, when you're receiving the cash from the buyer, the exchange is pure to the prorated rents and security deposits. Lender fees, such as points, prepayment penalties, and such. Lender fees are cost of financing. It's a cost of buying money. So those are not considered a cost of transferring the property. So those are costs that would ultimately be taxable, okay? And they're dealt with in a different way when you file your tax returns. Paying the buyer's closing cost. I see a lot of that, not uncommon, okay, where the buyer's saying, okay, I want you to pay for my closing costs. It depends on the kind of financing the buyer's acquiring. You just have to know that that's a potential taxable event. How your accountant deals with that at the end, that's the magic they work when you file your tax returns. Maybe there's some offsets to that, but you just need to be aware that there's certain things that could potentially be taxable and you'll pay tax on when you file your returns. Paying for the lender title policy. Also, any impounds. I see a lot right now when people are financing properties that the lenders are requiring impounds for, at least 3 months when they're acquiring it. Also, when you're buying your properties and you're having to get your insurance, the insurance is going to be, generally speaking, they're going to want the full year in advance. So those are the types of things that are going to be, if you're using exchange proceeds that are being funded through the closing, then that's potentially going to be boot and taxable. Just be aware. And then any property taxes that may be due, okay, because you're not going to sell it if there's property taxes due without them being paid. All right, so those are some of the issues, and I already addressed the issue in regards to insurance. So those issues are considered not qualifying as exchange expenses in an exchange. Okay. Now, when you're doing an exchange, and I'm going to bring this up because it's really important that people understand, I'm sure most of the people that are listening to this webinar understand that the exchange must be set up prior to the closing of the sale of the property. Okay, the qualified intermediaries documents must be signed prior to the closing of the transaction. And they're going to wire the funds to us. The date of closing starts a time frame, and then when we are doing on the replacement property side, we're going to have exchange documents on that side. But the date of the closing, as I mentioned earlier when I talked about the time frames, this is when the time frame for the exchange is going to begin, the date the sale closes. Sometimes people go, well, isn't it when you receive the money from the closing attorney or the escrow company? And the answer to that is no, because it may take a day or two before we actually receive the funds coming in from a wire. So it's the date that the actual transaction closes. That is day 0 and starts the clock, and the clock's not going to stop by then. So what's important is to know your timing. So when you get into a contract to sell your property, you should really be looking already for where you're going to buy, what you plan on purchasing. When you're this far ahead of the game, it helps mitigate the anxiety that you're going to be dealing with in the first 45 days of the transaction. And I don't mean to, I'm not going to make you scared of the 45 days. The term I like to use, and I use it often, keep your eye on the prize. Because what is the prize? The prize is keeping, not paying the taxes when you're doing a 1031. You're deferring those taxes on to the next transaction. How can you monetize that statement? Think of it this way. If I had to pay $100,000 in taxes on the sale of my property, and I was going to leverage that $100,000, say at 75%, I can buy what? $400,000 worth of property. So if I'm not giving if I'm using my money, my hard-earned, growth, all my pain and suffering while I've operated a property, okay, all that, I can now take that money, instead of having to pay taxes, I can use that to expand and to grow my portfolio, okay, like the earlier example. So that's one of the beautiful things about the 1031. That's why I say keep your eye on the prize when you're doing a 1031. So that 45 days is going to be important. Yes.
I have one real quick question that's appropriate.
Sure.
It's on the 45 days since you're talking about it. Christina writes, do you have to close on all the properties identified in the form?
Okay, that's a good question, and that's a beautiful segue
Hey,
into the identification rules. This was not pre-planned.
no, it was
So
not.
yeah, hold that thought for a second because I'm going to cover it. Okay, so there's when we talk about identifying, there are 3 rules. The first rule is the 3 property rule. I like to look at each rule's defaulting to the next rule. So under the 3 property rule, you are physically limited to 3 addresses, but you are not limited to dollar amount. So if I sold a property for $400,000, I can identify a property for 600, one for 550, another one for 750,000. I can buy whichever one I want. Okay, I don't have to buy all 3, but I'm physically limited to 3 addresses. So people tell me today going, well, gee, Dino, that's kind of hard. There's not a lot of inventory out there. I mean, I want to identify more properties. Okay. So if you go to the next rule, that means you can, the 200% rule, it allows you to identify 4 or more properties. But here's what you have to be aware of. You are limited by the total value of all of those properties that you're identifying cannot exceed 2 times your sale price. So if I sold for $400,000 and I wanted to identify 10 properties, then those 10 properties in value cannot exceed $800,000. To the extent it does, now I'm into the 3rd and final rule, which is the 95% rule. To sort of answer her question, is if I'm in the 95% rule, that means that I've identified more than 3 properties, so 4 or more. My aggregate values of all the properties I've identified exceeds 200% or 2 times my sale price. In that instance, I would have to close on 95% of the total value of all of my properties. So if I sold for $400,000 and say I identified 5 properties totaling $1 million, I would have to close on $950,000 of that $1 million. So unless one of my properties is only $50,000, I'm going to have to buy my entire list. The first 2 rules, the 3 property rule and the 200% rule, you do not have to buy your entire list. Okay, so again, you can only buy what's written on your list. Can't change the list after the 45th day. It's very, very specific. Now, one thing I will say for those of you that are looking at new construction and you're identifying property, you're being given addresses for the properties that you think you're acquiring. You need to double check, triple check, quadruple check that that address is actually going to be the address that you are going to be acquiring. Keep that in mind, okay? Because if you're told the property is 123 Main Street, and now maybe it's a corner lot, and it's going to be 321 Second Avenue, then even though you think you're buying the same property, that's not what you identified. So be very, very careful. When you're doing an exchange, it's really important to make sure that there's good communication with your, who's helping you acquire the property, along with the qualified intermediary, to make sure everything is lining up as best as possible. You want to make sure that whatever addresses you're putting on those lists are the addresses of the property that you may wish to acquire as a part of an exchange. I can't stress enough, you cannot change your list after the 45th day. Keep that in mind. Okay, now, other things to remember that in some of this stuff is because I deal with transactions all day long. I like to say, well, I bring them in. The team actually does all the hard work. They do the heavy lifting. But we're dealing with this stuff all the time. There's times where investors are buying replacement properties. And when you're out buying your replacement property, for those of you that have already done this, you're probably very familiar with what happens. For people that are now embarking in this in these waters here, you want to know what to be prepared for. I think it's very important that investors have reserves outside of any exchange proceeds to deal with the transaction itself. For example, when you're out buying properties and you make an offer and say your offer is accepted, there's going to be an inspection period, right? I mean, you should always inspect the properties that you're going to buy. I believe that's very common with RealWealth. They say it's a good idea to do that. So you're going to pay for an inspector. I don't know of any inspector that waits for their money. So you're going to have to make sure that you have reserves to cover any costs for an inspector. I know personally, I was doing my own exchange last year, and I had a couple of properties that I had made offers on, accepted offers, did the inspection, paid for the inspection, and ended up not buying the property. So keep in mind, you're going to have to have those funds outside. So have a reserve built up for inspections, for any kind of appraisals that may be done. Most lenders that I'm seeing want the appraisal paid for before the closing takes place. So just know that you should have some reserves in the background. Another item that comes up in the 1031 arena is people want to protect themselves by getting limited liability companies and such. When a taxpayer is doing an exchange, the same taxpayer selling must be the same taxpayer purchasing. Now, why am I using the word taxpayer and not title? Because you can show on title one way, but that may not be the taxpayer. For example, if I have my property in a revocable living trust, then the title is showing my revocable living trust. But is the trust the taxpayer? In my case, it's not, because it's a revocable living trust. It's there for estate planning purposes. Everything flows to my personal tax ID number under my personal return. So if I'm selling out of my trust and I buy in my individual name, because some lenders do not like lending in a trust, that's okay, because I'm still the same taxpayer. Same with an LLC. If I have an LLC where I'm a single member LLC, that's considered a pass-through entity, also known as a disregarded entity. So that, in other words, everything flows to my personal tax ID number. If I sell in that LLC, I can buy either in my individual name, I can buy in my revocable living trust if it's disregarded, or I can buy into an LLC that's also disregarded. So sometimes people will buy into their LLC, the member of the LLC will be their trust, which ultimately flows down to the taxpayer. That's why you can't just look at title to determine tax ownership, okay? So if you have a husband and wife that have chosen to be taxed that have an LLC in a community property state, I don't want to get too specific here, but if they're in a community property state, that LLC can be either disregarded or it can be taxed as a partnership. Some people have chosen, husband and wives have chosen to be taxed as a partnership. If you're taxed as a partnership, and this is, we see this a lot in 1 to 4 acquisitions, when you're selling your property and now you're going to buy a new property, you have to buy in the name of the LLC, because a partnership is the taxpayer, not the members. So when you're thinking about selling a property, or when you're thinking about buying a property, okay, understand who is the taxpayer, because that's the party that's selling, that's the party that needs to be purchasing. If anybody owns property in S Corps or C Corps, you need to speak with your tax advisor, because it's generally a financing issue when you have partnerships, S Corps and C Corps, when you're dealing with 1 to 4s. Very difficult to find financing, not necessarily impossible, but you're not going into your normal financing when you're in these kinds of entities. So just keep, vesting issues are one thing, tax ownership is another when it comes to an exchange. Now, what's happening is when people are selling an investment property, and say, for example, that the value of that property, the property they're selling, I should say, has very little debt on the property. Okay, so they had it for a long time. Now they're selling that property. Now they want to utilize leverage so they can buy more. Sort of like the beginning example, right? The person that sold for $1.4 million ended up buying all those properties. I had a transaction that they were selling, and actually the price was $400,000. And so they had zero debt on that property. This investor had owned this property like 15, 20 years. We're selling a property out of California, and they wanted to go and buy different properties in Florida. I think they were looking in Alabama and the Carolinas. And they wanted to utilize leverage. This investor's goal was to put 25% down, so therefore they can buy as much property as possible. Now, if you're thinking about, somebody selling at $400,000, and let's just say that $400,000 was the cash coming into the exchange. If you think of the leverage opportunity there of putting 25% down, they can buy what? $1.6 million in property. Well, which identification rule are they in now? All right, they're not going to be in the 200% because it's already gone past that. If they're utilizing leverage to that extent, they're going to be in the 95% rule. So the danger in trying to use too much leverage in a 1031, you have to be careful which identification rule you're going to use. Now, sometimes people go, well, do I have to put leverage on everything, or can I buy some all cash? That's an investor by investor decision. And you don't have to do everything equally. As when you're selling, you can put a certain amount of cash on one property, put another amount of cash on another. So to bring it a little more to light, think if I've got, say, $500,000 of cash, and I'm buying two properties. Maybe one property I only want to put, $300,000 on, the other property $200,000. It doesn't have to be $250 or $250. You allocate as an investor however you want to put that down, okay? So just keep that in mind when you're using leverage. Think of all the advantages that it brings, but watch the identification rules and knowing that you're in an exchange. Sometimes you may have to forego getting all the properties, and at that time, maybe later you refinance and go buy outside of the exchange, okay? And then now we'll just go ahead and should I turn it back to you now, Ben, and you can go through your advanced planning?
Sure. I mean, yeah, absolutely. I mean, what we're finding nowadays is, RealWealth has 20 different markets around the country that we've identified as markets we like, but they have properties. And a couple years ago, most of them were doing rehab stuff, turnkey. A lot of them still do turnkey, but what we've seen is a pivot to new construction. As some of the markets, especially in the Sun Belt, there's just not enough properties to rehab anymore. And so like Jacksonville, for example, they've switched completely to new construction. Good is that it's brand new, depending on your perspective. But the downside is that it's not like there's a lot out back with 20 brand new properties sitting there and you can just go select. I like the green one on the right. I mean, you have to wait. They need to be built in many cases between 6 and 18 months between the time that you say, I want that property, I'll sign an agreement for it, a purchase agreement, and 18 months later, it's done. So it's not, doesn't work with 1031s in many cases because of this 45 days, but this 180-day deadline we've been talking about for the last 45 minutes. So a way to look at it, that people ask me this all the time, there is a way, not around that, but a way to deal with that. And it just involves thinking in advance. Don't do the traditional, I sell my property, I have 45 days to identify what new ones I'm buying, and I have 180 days to close on those, A, B, C. Reverse it a little bit. And so what you do is you put a $5,000, in most cases, EMD, earnest money deposit, down on new properties. So say, I know I have it doesn't matter where it is. I'll just use the California example. I have a California property. It's going to sell for probably around $750,000. I'm going to do a 1031 exchange on it because it's been a rental for a long time. Don't do that now because you won't be able to buy any new construction properties and have them close in 6 months. Think a little bit differently. So what you do is you identify and put $5,000 earnest money deposit down on, I don't know, 3 or 4 new construction properties. Do that now. Let's just say it's January. Boom, $5,000 on property number 1, property number 2, property number 3, and let's make it 4, property number 4. The clock starts ticking. You're on the hook for those properties. You've put your stake in the ground. You're going to buy those properties, but you haven't sold your California 1031 relinquished property yet. You just bide your time. Take a deep breath, go about your life. All is wonderful with the world, and then keep in touch with those 4 people. And then when those properties are almost done, in other words, you're keeping in touch and they're about, I don't know, 2 months away from being done. They've built them, they're standing, they've got a roof, maybe they have to, do the landscaping, put the fence up. Great, they're definitely going to be completed. Now you put your California $750,000 property on the market. It sells fairly quickly. You've got your closing date, and you already know what properties you're buying because you put a stake in the ground a year earlier, 10 months earlier. So a lot of people don't think about that. You're not changing the rules. You're just buying the new ones or putting a stake in the ground for the new ones well in advance of selling the property that you're 1031ing out of. And that's what a lot of people need to do if they want new construction. Now, if they want rehab construction, that's okay. We still have several markets that are doing the rehab stuff. They will be ready in 180 days because they're already standing. All they need to do is rehab them. That takes 2, 3, 4 weeks. So you don't have to do that. But if you really want new construction, you have to think in advance. And I just wanted to really emphasize that because I get that question a lot.
Yeah, just to piggyback a little bit on that, when we have transactions that people do have new construction and they've already sold and they're looking at new construction, and there may be some out there. I mean, it's tough. There's no doubt about it right now. You have to look at when is the contractor say it's going to be complete, and you have to allow for delays because that's happening in the market right now. And so if you're in an exchange, I had a conversation with someone yesterday, and their closing is the beginning of next month. Their 180th day would be toward the end of October. And we were talking, she said, well, I saw some new construction. I said, well, when does the contractor feel he can deliver the property to you? And she says, well, by July. I said, okay. I said, if you've got a delay of another, say, 30 days, you're still pretty safe. I said, but if you have a property that you're looking at and the delivery date is, for example, September, I wouldn't feel that comfortable that I'm going to be able, that, there's going to be no hiccups, no delays of any sort, that I'm going to be able to finish my, get this property closed by the 180th day. Because you have to understand, by the 180th day, you have to be on title to that property. Okay, so there's no, well, the contractor couldn't get it done, or there's a supply issue or whatever, there's no forgiveness. There's no forgiveness in that. So be very, very careful if you're already in a transaction and you're looking at new construction. We do see a lot of what, some people what Ben talked about, that they're getting under contract now, and then they're waiting for, to get some level of, maybe 3/4 of the way, maybe not just waiting for the landscaping to be put down, because
right.
Right now the market is so hot. You put your property on the market and you're under contract, usually within 48 to 72 hours, but is that going to continue? We don't know. I mean, none of us have a crystal ball, but what they're doing is they're getting under contract, and then they're kind of timing it sort of like what you said, and then selling their properties. And sometimes people go, well, can I get my $5,000 back? All right, because you're putting the funds in advance. So you can put your earnest money deposit down on a property and have that refunded to you at the close of the purchase. So there's ways of dealing with that in an exchange. So just be aware of that. But you are going to have to front that money when it comes to something of this nature. So just when you're looking at new construction, stay grounded in the timing of everything, and just feel comfortable that it's going to be completed in time for the exchange to be completed. Okay. So very important to know. And sometimes people call that a reverse exchange, and it's not. Okay, it's just excellent planning. We've got a lot of deals right now where the sales and the purchases are happening within 48 to 72 to 96 hours of each other, because they're already under contract with the replacement property. And as soon as we have the money, and all the documents are in place, they can turn around and we can wire those funds directly for the next closing, and the exchange can be done relatively quickly. Okay. So
perfect.
Okay.
All right, let's see, what do we have next?
Just my face.
Well, we have a lot of questions right here. I tried to knock down the list a little bit by knocking on some of them, by addressing them at the time. But why don't we just real quick, in case we're getting close to the top of the hour, we're probably going to run over a little bit. So I just want to address, here's how you reach Dino. There is her office line, her cell phone number, her email address and address. So we'll just leave this slide up for a little while just so that people can copy that down, and then in a couple minutes we can advance to the slide that just says questions. And we'll go ahead and get some of the questions right now. Let's see, will there be a replay? Yes, there will be. We will archive it on our website sometime tomorrow or the next day. We've got two questions that are actually similar here. What about someone who is house hacking in a duplex and wants to do a 1031 to go from a duplex to a fourplex with him or her occupying one of the units in the new fourplex?
Okay, so am I to take hacking means they live there?
Yes.
Okay.
Yeah, right. Exactly. House hacking meaning it's a multifamily thing and they live in one.
Okay.
Yeah.
All right, so the answer to that is it would be called split treatment. So in other words, the unit that you're living in is not going to be a part of the 1031. So, so your accountant would have to allocate the value of the units. So if you went from a duplex where you're living in one of the units, renting out the other, only the unit that's the investment unit is going to be a part of the exchange. Now, if you're looking to exchange that into another property in which you plan on occupying one of the units, just keep in mind that only the investment funds and such can be used for the investment funds. If there is no debt on the duplex that you're selling, before you're going to do that, let's just use this as an example. I highly recommend that you speak with your tax person to have advanced planning on dealing with this issue, because again, you can only use exchange proceeds for the exchange portion, and then you still, if there is debt, you have to deal with the debt component. So it can get very, very tricky. So hopefully you have a very good, competent tax advisor that can guide you through that process.
Yep. And this a lot of people ask, this is a kind of a related question, but if one wanted to do that, how long can I buy a duplex and live in one? Also, you just addressed that. Also, how long does it or any property need to be a rental before they decide if they want to live there and claim as a primary residence?
Very common question. When you're doing an exchange, the taxpayer has to have the intent to hold the property for investment purposes on both sides of the equation, the sale as well as the purchase. There's nothing in the code that mandates any specific holding period in order to achieve that quote unquote intent. So it's going to be a discussion had between whoever does your taxes and the person that's wanting to, trying to get some information about how long before I can move into the property. You have to establish it as an investment property. My pat answer is usually longer is always going to be better than shorter. Okay, anything under 2 years, under a year becomes extremely risky unless there was something that that your intent truly was to hold it as an investment, but something altered that. You can need to speak with your tax advisor to determine when is a good period. The next thing you need to know, because sometimes people have a strategy saying, well, if I move into the property, I turn around and now I want to sell it, thinking I'm going to be able to get off what I used to call the exchange train. There's rules associated with that under the primary residence tax code. So if you're thinking about moving into a property after you've established it as an investment property, living there for 2 years, so say you rented it out for 2, you move in it for 2, and you got the end of the 2 years, you go, I want to sell it now under the primary residence code. You cannot, because you have to own it for 5 years because you exchanged into the property. So there are certain requirements when you're converting a rental to a residence and how you work with the primary residence tax code.
Right.
Okay, so.
Okay, makes sense. Okay, this is a relatively simple one from Rory. Can you start a traditional exchange and then after a few months pivot to a reverse exchange if issues arise with meeting the 180-day deadline?
Well, the answer to that would be if you've already, I'm not sure what you mean by start. If for example, I can go 2 ways with this. One, let's just say you have a buyer for your relinquished property, you get under contract, you found a replacement property that you're under contract with. Let's just say that the buyer of the property you're selling, it falls out, but you have no extensions on how you're dealing with the replacement property. Is there a possibility for a reverse exchange there? There's a possibility for it. They do exist, but you have to make sure where you're getting the money to buy that new property. Mm-hmm. Now, if you meant you started the exchange and that means the sale is already closed, the qualified intermediary is holding your money, then that's a forward exchange. There's no reverse that's coming in that. So when you think of a reverse exchange, that only applies when you have to close on the replacement property before you have closed on the relinquished property. Okay.
Got it.
And they're expensive, by the way, just know that.
Reverse exchange are expensive.
Yes.
Yep. Can you exchange from multiple properties into one property?
Okay, the answer to that is yes. Okay, so basically you're consolidating. What you have to understand is the timing of all of this. So for example, if you're wanting to sell 3 properties to buy 1 property, you can do that because say you're needing all the cash from all 3 to get the new property. What you have to understand is the time frame for the exchange is going to begin at the closing of the first property. So you want to make sure that properties 2 and 3 are going to close comfortably close to when that first one closed, because now you feel comfortable that you can close on that purchase. All right. Mm-hmm. But the timing, you're gonna have to watch the timing of these transactions. If you want to have 3 you want to put in one transaction to buy 1, say 2 are closed, but the 3rd one hasn't closed, and you have enough cash or you can get enough of a loan to still buy that 1 property, you merely take that 3rd property out of the exchange, and then you can proceed to purchase that replacement property. But you have to understand when you finally sell that 3rd property, it cannot be used to buy that property you closed on. You have to go out and buy new property. So those are very tricky. Those are very tricky in getting the timing together. All right. Mm-hmm. So all the sales have to close before you can buy the purchase. Close on the purchase.
Now, I know that we aren't going to get into reverse exchanges. They're complicated, they're expensive, but we've had several questions of people saying, what are they? So can you just like explain just like in 30 seconds what exactly it is?
Okay. A reverse exchange means you're closing on the purchase before you close on the sale. The reason it's a complicated and expensive exchange is because you as the taxpayer cannot be untitled to both the property you're selling and the one you're purchasing. So we as a qualified intermediary create an LLC, which the technical term is exchange accommodation title holder, where we create an LLC and we go untitled to the property that you're looking to purchase. So if you have all cash, that makes it easier because you're not dealing with lender issues. If there is a lender involved, then you need to make sure the lender is on board with this. Right. And I will tell you, probably 90% of them are not. Okay, so that's what the reverse is. Basically, people utilize this mainly on the more expensive properties where they're locking in their purchase before, they know that their sale is going to go and they have the capacity to do that. Okay. It is an expensive exchange.
Yeah,
So.
absolutely. Can you touch on the costs of the services, not of just your services, not so much the reverse, but just how much does it cost?
Yeah, a typical fee for an exchange runs $1,000. It covers a sale and up to 3 purchases. We don't charge for wires, document redraws, anything of that nature. So it's I like to say we're the least expensive thing in the transaction that saves the most amount of money. Right,
there you go. Okay. All right, I'm gonna eliminate all these questions on what reverse exchanges are. Mayank Patel says, kudos to Dino and her team. They have helped me with 5 exchanges. They completed perfectly, so thanks a bunch to her and RealWealth.
Yay.
Yay. Love that. Wanted to throw that one in there.
Thank you.
All right. God, so many questions here. When you can address, is a self-storage unit facility regarded as a 1031 real property or 1245 code personal property to do a 1031?
Well, it depends on whether you've done cost segregation or not, but typically it's, is how is it being treated on your tax returns? Okay, did you cost segregate the property? If you cost segregated the property, then now you're sort of pulling it out from the real property. So you have to check into that. But
right.
if you haven't cost segregated anything, then it's typically just considered investment real estate. So
and the fact that it's a storage facility, it's still like kind, like you addressed earlier. If it's an investment property to an investment property, the fact that it's a bunch of little roll-up doors and people storing their stuff there, it's still like kind.
Yes, exactly. Yeah.
If it's an investment. How long must you own your rental before you can sell it and qualify for a 1031 exchange?
Well, it gets back to that same non-answer to the question
right.
is, did you hold it for investment purposes? There's nothing in the code that mandates a specific holding period. So did you hold it for investment purposes? What people, so I will ask, so when you bought the property, what was your intention? Well, I wanted to fix it up and I wanted to sell it. Well, then technically that your intention was what? To fix and flip and not fix and hold. So can you qualify? How long? There's nothing in the code that mandates a specific time.
Right.
Longer is always going to be better than shorter to establish the held for investment intent. Not the only thing, but one of them.
Mm-hmm. Got it. And this is a little bit specific, but I think you can address it fairly quickly. There was a question how at the beginning of this webinar, you mentioned that Pennsylvania is the one state that doesn't follow 1031s. So what that essentially means, I mean, the 1031 is a federal code, so
yes.
They can still do it. It just means that the state of Pennsylvania may
collect their tax.
Right. Okay. But I mean, the majority of it is going to be the feds. It's a federal tax code, so you're okay.
Exactly.
Right. Okay. Is there an extension in disaster situations? For example, total loss of properties from fire. I think they're referring to, hey, I had 4 properties or 3 properties on my identification list and one of them burned to the ground.
That's a good question, and that gets really specific. It was on the ID. There's no extension in that regard because it's identified property. Okay.
Right.
So I don't see an extension in that example itself. Okay. But there are extensions for natural disasters. We had one not too long ago with the ice storms in Texas. And we had some people that actually were able to utilize the extension because they were affected by those transactions. They were selling out of those regions. So when there's a presidentially declared disaster, you need to consult your tax advisor to see if it's something that you can qualify for. And it gets very specific. We don't interpret that for anybody. We give you the information. We have you go to your tax person, so therefore they can interpret it for you. But we've had some clients that was able to take advantage of that because of the ice storms in Texas not too long ago. Seems like forever now, but
right.
They were able to utilize it. So.
Okay. All right, I think we've whittled it down. Let me see if there's anything else. You addressed the whole 1031 Biden exchange at the very beginning. It's all just thoughts, so let's not worry about it until it becomes reality, which it may or may not. We talked about the names on the title. We talked about that. I'm trying to see if there's anything here that is new. I don't think so. I think that's it. I mean, I think we've addressed everything here, and we don't have anything more to talk about other than just you've got Dino's name and number. If you want to talk to any of us here at Real Wealth Network, we don't know nearly as much as Dino, obviously, about 1031s, but we know enough just to be dangerous about it. And sometimes people bounce ideas off of us. But by all means, reach out to Dino and get all your questions down to the most granular detail answered. And that about covers it. Any final thoughts, Dino, from you?
No, just happy investing. Thank you for the opportunity to chat on the subject. Feel free to reach out, give me a call. I'll be more than happy to answer your questions. Just know that we're in a very robust, frothy market. So planning, and more planning.
Yeah, absolutely. And especially when it comes to new construction, we have people in Real Wealth do exchanges all the time. So don't be afraid, like, oh my God, the market is scary. Well, I mean, like I said earlier, with rehab properties, it's a lot easier because they're already built, and all the stress that goes along with, steel being waylaid in the Salton Sea somewhere, or, bad example, but, supplies not getting there on time and the new construction not getting built, those really don't exist with the existing properties. But we earlier came up with a solution for how you address new properties. But it absolutely can be done. Just take a deep breath, don't get stressed out, work with us, work with Dino. We can always find you stuff. It gets a little scary if you've got like a $3 million exchange and you want to maximize leverage and buy 40, that may not be doable. But most exchanges aren't to that exchange, and not to that extreme, and it's completely doable.
Clearly.
All right. Okay. Well, Dino, thank you so much.
My pleasure.
I appreciate it, and thanks all of you for watching. And we'll do it again exactly a week from today, talking about Nashville. And a couple weeks from today, Joe's going to talk about a bunch of stuff in terms of mistakes to avoid. So love to see you all back in a week, in 2 weeks, and every week. Thanks so much. See you next time.